Imagine it's December 31st, 2026. You're sitting at your desk, looking at your bank account, and for the first time in your life, you aren't stressed. You aren't wondering where the money went. You aren't checking the news to see if the stock market crashed today. In fact, you haven't checked the news in months. Why? Because you stopped playing the game that 99% of people lose. You see, most people treat the stock market like a casino. They chase the next big thing. In 2021, it was crypto. In 2024, it was AI. In 2026, it'll be something else entirely. They spend their weekends watching top 10 stocks to buy now videos, sweating over every red candle, and paying high fees to managers who can't even beat a simple index. They are exhausted. They are stressed. And ironically, they are usually poorer than the person doing absolutely nothing. Today, I'm going to show you how to do nothing the right way. I call it the zero stress portfolio. It consists of only 3 ETFs. That's it. No individual stocks, no complex options, no 2 a.m. panic selling. The 2026 economic trap. But before I give you the tickers, we need to talk about why 2026 is a different beast. We have entered an era of higher for longer interest rates. The cheap money era of 2010 to 2020, where you could throw a dart at a board and make money, is dead and buried. Inflation isn't just a temporary glitch anymore. It's a sticky reality that eats your savings while you sleep. Plus, with AI integration moving at lightning speed, we're seeing a jobless recovery. Companies are more profitable than ever because they are efficient, but they need fewer people to run them. This means your active income, your salary, is under more pressure than ever. You cannot afford to lose your passive income to stupid mistakes. The old advice of just buy the S&P 500 and chill is still decent, but in 2026, it's incomplete. Why? Because the S&P 500 has become a tech-heavy monster. It's a bet on 7 to 10 companies. If Apple, Nvidia, or Microsoft has a bad quarter, your whole retirement plan takes a hit. That's not zero stress, that's a concentrated gamble. The psychology of the comfort gap. Before we look at the first ETF, you have to understand a concept I call the comfort gap. This is the distance between the money you think you need and the amount of volatility you can actually handle when the screen turns red. Most people think they are aggressive investors when the market is going up 20% a year. Everyone is a genius in a bull market. But the moment the market drops 10% in a week, they realize they are actually very conservative. They panic, they sell, they lock in their losses. The zero-stress portfolio is designed to bridge this gap. It's designed so that when the market drops, you don't even feel the need to open your app. You know your brakes are working. If you want to actually build wealth without the stomach-turning volatility, you need a balanced engine. Think of your portfolio like a car. Most people build a car that is 100% engine and no brakes. It's fast until it hits a wall. Other people build a car that is all brakes, cash and savings accounts, and they never actually get anywhere. They just watch their purchasing power melt away. The zero-stress portfolio is the perfect hybrid. It's built for this specific economy, where technology is exploding, but risks are everywhere. The failure of stock picking. Let's be honest for a second. Why are you trying to pick the next Tesla or the next Amazon? The math is against you. Over a 10-year period, 85% of professional fund managers, people with PhDs from Harvard and supercomputers on their desks, failed to beat a simple index fund. If they can't do it, what makes you think you can do it while working a 9 to 5 and scrolling through Twitter? When you pick an individual stock, you are taking on uncompensated risk. You are betting that you know more about a company than the millions of other traders. You are betting that there won't be a scandal, a product recall, or a sudden change in management. In a zero-stress world, we don't take bets we don't have to. We buy the whole haystack instead of looking for the needle. ETF number 1, the World's Engine. VT, Vanguard Total World Stock ETF. Now, let's break down why this is superior to the S&P 500 only strategy that everyone else is preaching. When you buy the S&P 500 VOO, you are betting 100% on the United States. And look, America has been the greatest economic engine in history, but history is full of unbeatable empires that eventually slowed down. Remember Japan in the 1980s? Everyone thought they would own the world. Their stock market was unstoppable. Then it crashed and didn't recover for 30 years. If you put all your money in one country, you have a single point of failure. VT is different. When you buy one share of VT, you're not just buying America, you're buying the world. You own a piece of over 9,000 companies across every continent. You own Microsoft and Apple in the US. You own Toyota and Sony in Japan. You own Nestle and Rocher in Switzerland. You own Samsung in South Korea. You own HDFC Bank and Reliance in India. You are also diversifying across every developed and emerging market on the planet. This is the ultimate shame-free way to invest. Why? Because you don't have to be a geopolitical genius. You don't have to predict whether China will overtake the US or if India will become the next manufacturing hub. You just have to be right about one thing, that the human race will keep working, innovating, and consuming. As long as people keep buying phones, driving cars, taking medicine, and using the internet, somewhere in the world, you are making money. The currency hedge. In 2026, there is another major risk, the US dollar. For decades, the dollar has been king, but with rising global debt and new trade alliances, the dollar's dominance is being challenged. If you only own US stocks and the dollar loses 20% of its value, your real wealth just shrank by 20% on the global stage. But because VT holds international stocks, you're hedged. When the dollar weakens, your international holdings in euros, yen, or rupees actually become more valuable in dollar terms. It's a built-in safety net that most investors completely ignore. The math of the snowball. Let's look at the numbers, because numbers don't have emotions. Over the last century, the global stock market has returned roughly 7 to 9% annually after inflation. We don't look for 100% returns in a week. We know that fast money usually leaves just as fast as it comes. We look for the snowball effect. Suppose you start with $10,000 and contribute $1,000 every month. If VT gives you a conservative 8% return, in 5 years you have $85,000. In 10 years you have $195,000. In 20 years you have over $600,000. And that's without you ever picking a single stock. You didn't have to read a balance sheet. You didn't have to listen to a CEO's lies on earnings calls. You just bought the world and went to sleep. The red line problem. But there's a catch, and this is where most people fail. Stocks do not go up in a straight line. They are jagged. They are volatile. In 2026, with high-frequency trading and AI-driven bots, market swings are faster and more violent than ever. If you see that $195,000 drop to $140,000 in a matter of weeks, your brain will scream at you to sell. Your lizard brain is designed for survival, not for long-term compounding. It sees a loss in your portfolio as a physical threat to your safety. This is why you cannot have a portfolio that is 100% VT unless you have nerves of steel. And let's be honest, most of us don't. We need to install the suspension system. We need the shock absorbers that keep the car on the road when the weather gets bad. Without these shock absorbers, you aren't an investor. You're a gambler waiting for a heart attack. You need to understand that the goal isn't just to be right about the market. The goal is to be unbreakable. You want a portfolio that allows you to sleep through a recession. This brings us to the second pillar of the zero-stress portfolio. As I mentioned, an engine without suspension is a death trap. If you hit a pothole in the economy, a recession, a war, or a sudden spike in interest rates, a 100% stock portfolio will vibrate so violently that most people will jump out of the car. They sell at the bottom because they can't handle the G-force of the crash. To prevent this, we need to talk about the part of the portfolio that makes the ride smooth. ETF number 2, the shock absorber, BND. I know what you're thinking. Bonds are for my grandfather. In the 2010s, you were right. When interest rates were zero, bonds were return-free risk. They paid nothing and offered no protection. But we're in 2026. The world has shifted. When you buy BND, you're not a part owner of a company. You're a lender. You're lending money to the US government and high-quality corporations. In exchange, they pay you a fixed interest rate known as a yield. In 2026, these yields are finally respectable again. You can actually get 4.5 or 5% just to sit and wait. the negative correlation magic. The real power of BND isn't just the 5% interest check, it's how it behaves when the world is on fire. In the financial world, we look for negative correlation. Historically, when the stock market, VT, enters a bear market and drops 20 to 30%, investors panic. Where do they take their money? They take it to the safest place on earth, US Treasury bonds. When everyone rushes into bonds, the price of BND goes up. So while your VT is bleeding red, your BND is usually glowing green. It offsets the losses. Think about the math of a 20% market crash. If you are 100% in stocks, you lose $20,000 for every $100,000 you have. If you are 70% in stocks and 30% in BND, and those bonds stay flat or go up 2%, your total portfolio might only be down 12% or 13%. A 13% drop is a bad month. A 30% drop is a life crisis. By holding BND, you buy yourself the psychological strength to stay invested. ETF number 3, the Inflation Shield, IAU. Now we have an engine and suspension, but what happens if the road itself starts to melt? That is what happens during hyperinflation or a currency crisis. We are living in an era of massive government debt. Governments are printing money to pay for infrastructure, social safety nets, and interest on their old debts. When the supply of paper money increases faster than the supply of goods, the value of each dollar, euro, or rupee shrinks. This is where the third pillar comes in. Gold is the ultimate no-stress asset for one simple reason. It is the only financial asset that is not someone else's liability. A stock is a claim on a company. The company can go bankrupt. A bond is a claim on a government. The government can default. Gold is just gold. It has no CEO, no balance sheet, and it cannot be printed into oblivion by a central bank. In the zero-stress portfolio, gold isn't there because we are preppers or because we think the world is going to end. It's there as a volatility hedge. When inflation spikes, stocks often struggle because companies' costs go up. Bonds struggle because the fixed interest they pay becomes worth less in real terms. But gold has held its purchasing power for 5,000 years. An ounce of gold bought a fine suit in ancient Rome, and it buys a fine suit today. By holding just a small amount of IAU, around 10%, you create an armor for your portfolio. It's the insurance policy you hope you never need, but you're damn glad you have when the headlines start talking about currency devaluation. The 2026 blueprint, how to assemble the machine. Knowing the ETFs is only half the battle. The other half is the allocation. How much of each should you own? In 2026, we use a slice and dice strategy based on your life stage and your specific risk tolerance. The Wealth Builder, ages 20 to 40. If you are young and your primary goal is growth, but you don't want to lose your mind during a crash, 80% VT, the engine, 10% BND, the shock absorber, 10% IAU, the armor. This is a high-octane setup. It will grow fast, but the 20% in bonds and gold will prevent you from experiencing a total meltdown. The Peace of Mind Seeker, ages 40 plus or low risk tolerance. If you have already built a decent nest egg and your goal is to make sure you never have to go back to work, 60% VT, 30% BND, 10% IAU. This is the classic all-weather approach. It's designed to provide steady growth while keeping the bumps in the road almost unnoticeable. The secret sauce, the annual rebalance. This is the part of the system that will actually make you a millionaire while others are struggling. Most people set it and forget it, but that's a mistake. Over time, your slices of the pie will change because some assets grow faster than others. Let's say you start with the 80-10-10 Wealth Builder plan. During a massive bull market in 2026, stocks go up 30%. Suddenly, your VT isn't 80% of your portfolio anymore. It's 88%. Meanwhile, your BND and IAU have shrunk to 6% each. Your portfolio is now too risky. You have too much engine and not enough brakes. What does the average stressed investor do? They see stocks going up and they buy more because they're greedy. They're buying high. What does the zero stress investor do? You do the opposite. You sell that extra 8% of VT and you use that cash to buy more BND and more IAU. Think about what you just did. Without reading a single news article, without listening to a Wall Street guru, you were forced by your own system to sell high and buy low. You sold the expensive stocks and you bought the cheaper assets. If you do this once a year, which I recommend doing it on your birthday or every January 1st, you will mathematically outperform almost everyone else over the long run. The exit from the rat race. The zero stress portfolio is more than just a financial strategy, it's a life strategy. In the 2026 economy, everyone is fighting for your attention. Apps are designed to make you check your portfolio 50 times a day. News channels are designed to keep you in a state of constant fear. The zero stress portfolio is your exit ticket from that rat race. It takes 15 minutes a month to execute. You set up an automatic transfer from your bank account to your brokerage, you buy your 3 ETFs, you rebalance once a year, that's it. The rest of your time, you spend it increasing your human capital. You work on your skills, you start that side business, you spend time with your kids, you go to the gym. Stop hunting for the next big stock. The hunters are the ones who get tired and eventually go hungry. The farmers, the ones who plant their seeds in broad, global ETFs, protect them with bonds and gold, and wait for the seasons to change, are the ones who eventually own the whole valley. In 2026, the greatest luxury isn't a fast car or a big house. It's a calm mind. It's knowing that while the rest of the world is panicking, your wealth is growing quietly, steadily, and automatically.